Okay, that's good. Hello, everyone. Thank you for joining us today. I'm Claire Reagan. I'm a partner in the finance and fund formation groups, and I spend a lot of my time, among other things that I do, helping both insurers and investment managers facilitate investment by insurance companies into mortgage loans, in particular, residential mortgage loans. The topic today is insurance company investments in mortgage loans, which is an increasingly significant topic. In October 2024, the NAIC released a capital markets special report with some statistics about the insurance industry's exposure to commercial real estate and mortgage loans in particular. The total exposure to commercial real estate was $995 billion, and of that, $770 billion is attributable to mortgage loans, which is over a 5.9% increase over 2022. Total U.S. insurer investment in mortgage loans has increased every year since 2010 and has nearly doubled since 2014. And mortgage loans represent approximately 9.4% of the industry's total cash and invested assets as of the end of year 2023, which was up from 6.8% of total cash invested as of year-end 2014. Of that, the bulk is still in commercial mortgages, accounting for about 84% of that investment, but increasingly, more and more investment is being into residential mortgage loans. Residential mortgage loans were the second largest type at 11.1%, and they were the primary driver of total mortgage loan growth in 2023, with its book adjusted carrying value increasing approximately 38% over the prior year. So that's a huge increase, and it's compared to only 3% in the commercial real estate space. So certainly has been reflective in what we've been seeing coming in, and I expect many of you listeners as well. So when you invest into whole loans, it's a more complex regulatory environment, and not everyone has the ability to kind of take and manage those investments the way that they do if it's simpler to invest in a securitized asset. So there's a whole regulatory overlay to all of this, which is very complex. And some of you may have joined us a little over a year ago. We put on a comprehensive program, everyone who's joining me today on the call, and along with some of our other colleagues. And we did sort of a deeper dive into all those different competing regulations that you have to think both at the investment level and in the insurance company level and everything. And so I would encourage everyone to go back and I think if you switch the, if you could move to the next slide, please. Keep going. Keep going, sorry. Here we go. This is back one right there. So what I wanted to point you all to. So we spent probably an hour and a half, a little over a year ago, diving into sort of all these different, you can see there's federal regulations, state regulation, insurance regulations that everyone has to consider. And those are different and obviously sometimes competing things. And so we have a program that we did, and the link is down here in this last bullet that you can revisit and get sort of a bigger overview of those different, not only the different regulations, but going into some of the practical considerations like the structuring and the relationship between the investment manager and the insurer, and terms, common terms and considerations that you have to deal with that. Today is meant to really supplement that prior program and get into some of the updates since that time and the current events surrounding insurance company investment into mortgage loans. And so joining me today, I have my regulatory colleague, Holly Bunting, who's going to talk about some of the regulatory updates. My insurance regulatory colleague, Larry Hamilton, who's going to talk about the different considerations relating to the treatment, RBC treatment of investments into mortgage loans and some new developments in that area. And then my finance colleagues, Tamim Zamobai and Hacker Goodmanson, who are going to talk about, they handle a lot of the actual investment into the mortgage loans. And so they're going to talk about some structuring and other considerations with that. So thank you all for being here today. If you have any questions during this, you can click the Q&A button on the bottom, it looks like a little square with a question mark, and your question will be entered into a chat. And if we have time at the end, we'll address those. So with that, I'm going to turn it over to my colleague, Holly. Holly, are you there?
Jesse, next slide, please. One more. Thank you. I'm Holly Bunting. I am a partner in the finance group in the Washington, D.C. office. I focus primarily on issues of regulatory compliance, primarily related to residential mortgage loans. So as Claire mentioned, in last year's program, we spent a considerable chunk of that program talking about various mortgage regulatory issues that arise. And so we don't necessarily want to repeat that now, but I do want to highlight that residential mortgage loans is a highly regulated industry. If you are new to mortgage lending, you may think about the origination of the loan as being something that is quite regulated, which is true. But there's also risks related to purchasing of loans, holding those loans, and then servicing those loans after your origination happens. And those requirements range from mortgage licensing requirements, which happen in every state on a state-by-state basis. There's no consistent nationwide structure for mortgage licensing requirements as it relates to residential mortgage loans. And then there's significant substantial requirements under both federal law and state law as well. And we're not going to get into the details. We could be here all day talking about the regulatory issues, but I do want to spend a couple of minutes highlighting some recent updates from our past discussion. Next slide, please. One of the things that we're hearing now a lot, especially now that we're in the second week of the Trump administration, is what impact do we expect that to have on the regulatory environment for mortgage lending? Interestingly, Director Chopra of the Consumer Financial Protection Bureau was still in his position. If you had asked us 2 weeks ago, I think we would have thought he would have resigned prior to the inauguration or would have been removed soon after President Trump's inauguration, but that hasn't happened yet. I think the focus has been elsewhere on other appointments. And so as it exists now, it's a bit of business as usual at the CFPB, although we certainly expect that to change in the near future. If this administration is anything like the last, and we think that there will certainly be some similarities from a consumer regulatory and a mortgage regulatory perspective, we expect federal regulators to focus on clear issues of consumer protection. So those restrictions and protections that already exist under federal consumer protection laws, as well as interpretations of those requirements. Under Democratic CFPB, we've seen often novel interpretations espoused by those particular administrations, and so we don't necessarily expect that to be the case here. Also, less regulation through enforcement. I think we can expect a bit of less of a focus on enforcement and using that as a way to make new law or to exert those new interpretations of existing laws as part of the overall sort of mortgage regulatory landscape. And then I think we can expect, once we do have a new director in the CFPB, that there will be a pause and a possible reversal of certain of the regulations and guidance that the CFPB put forth during the Biden administration. All of that's to come, of course, but I think the expectation is that things will cool a bit, although obviously there is a consumer protection mandate. That's the reason for the Federal Bureau. And so there will, of course, continue to be a focus on those existing laws that apply as it relates to mortgage lending. Another thing that we often see with a Republican president in their administration at the federal level is To the extent there are states with Democratic attorney generals, they often look at this as an opportunity to fill the gap. So to the extent that federal regulators are not as clearly focused on certain issues from a federal regulatory or enforcement perspective, we see that states sometimes will pick up the torch there and carry that a bit. So as we look forward, I think there's continues to be a focus on what the states will do, which is again a 50-state patchwork of various regulations, and then a bit of a cooling from a federal perspective. Next slide, please. One of the issues that is a bit hot off the press from a regulatory perspective that we want to focus on specifically in this webinar, and it relates to state licensing. I mentioned that there are risks that relates to purchasing and holding and servicing residential mortgage loans, and one of those relates to state licensing, that there are certain states across the country that require a license to purchase and hold and service mortgage loans. There's been new guidance in Maryland just issued January 10th by Maryland's Office of Financial Regulation, which is the regulator for state mortgage licenses in that state. And that guidance specifically says that assignees of residential mortgage loans, which includes passive trusts that acquire or obtain assignments of residential mortgage loans in Maryland, must become licensed as a lender prior to April 10th, 2025. Unless that particular assignee is already expressly exempt under Maryland law. This is guidance that follows on a court case from April 2024, where the appellate court in Maryland took the position that an existing assignee of a HELOC was required to obtain a license before they could foreclose in a Maryland court. And that court in 2024 took that position despite the fact that Maryland's existing licensing laws do not expressly require a license to purchase closed residential mortgage loans. Next slide, please. A little bit of background on that case. So as I mentioned, the statute requires a license to make a loan. And historically, that had not been interpreted or held to extend to entities or persons that were acquiring or holding title or asset to mortgage loans after their origination. In this particular case, though, the court said that because Maryland law generally upholds the principle that an assignee succeeds to the same rights and obligations under a loan agreement as the assignor, the appellate court held that the assignee of a loan that's made subject to the credit grantor provisions in Maryland is subject to the same licensing requirement that applied to the originating lender. In this particular case, the assignee, which included the statutory trust that was at issue, was required to obtain both the installment loan license and a mortgage lender license in Maryland. One thing the court did not focus on, and I think this is an important fact, particularly as it relates to how these types of arrangements are structured, but the court did not discuss whether their conclusion would have been different if the national bank that acted as a trustee for the trust in that scenario or in this case, which the national bank, of course, is exempt from licensing under Maryland law, if that was the party that had acquired and held the loans in its capacity as trustee, whether that would have changed the court's conclusion. Next slide, please. So where we are now is we have this new guidance from the Office of Financial Regulation, which expressly states that any assignee of a residential mortgage loan, including a mortgage trust, is required to obtain a license under Maryland's mortgage lender law to acquire and obtain assignment of those loans, regardless of the lien position of the loan. Of course, if an entity is exempt from the licensing law, it continues to remain exempt. So federally chartered banks, Maryland state banks, insurance companies that are authorized to do business in Maryland are all exempt from that lender license in Maryland. Also, state banks that are chartered in other states that have an office location in Maryland also remain exempt. It's also possible, in addition to that mortgage lender license, that an installment loan license could be required under the guidance. Next slide, please. In addition to the guidance itself, the OFR issued emergency regulations, which in their words were intended to create a way for passive trusts that are assignees of residential mortgage loans to satisfy the net worth and the qualified individual requirements under Maryland's license law. So again, we're not going into the details today. You can certainly hear in our session from last year, but in addition to the license itself, there's often many substantive requirements that an entity or person must meet before that license can be issued. Net worth is one example, qualified individuals another example, which in Maryland requires 3 years of background or expertise in mortgage lending. And so these regulations are designed to try to help these passive trusts satisfy the licensing requirements. I think there's some debate as to whether or not it's helpful. I still think there's some obstacles as part of the overall licensing process, but nonetheless, that's what we have at this point to try to create a pathway for those licenses by April. Another thing, of course, that the guidance does not specifically address, much like the court didn't address, is whether a trust would be required to obtain a license if it's structured in a way so that the national bank, which is exempt from licensing under Maryland law, is the party that acquires or obtains all of those mortgage loans in its capacity as trustee for that trust. It also doesn't address whether existing trust structures already set up that way must sort of change course and obtain a license. This is an issue of much debate. The SFA convened a call on this issue yesterday. There's certainly a lot of advocacy coalescing around this issue to figure out what the next steps are. But based strictly on a reading of the guidance that's issued, I think there's a pretty strong basis that the Maryland regulator, as well as a court in Maryland, could take the position that a trust structured in this national bank trustee model would need to obtain a license. There's certainly opinions on the other side of that. And it's an issue that I think we just have to keep watching on a day-by-day basis, but certainly impacts loans in Maryland. And to the extent loans are being held now, what happens going forward, or if new structures come into place, whether those licenses will be required in the future. All right, before I pass it on to my colleague Larry Hamilton, I want to give you all a CLE code. That code is mortgage 28, and the word mortgage is in all caps. Again, mortgage 28, and we'll share that again at the end of the presentation. All right, Larry, I'll turn it to you.
Thank you, Holly. I'm Larry Hamilton. I'm based in the Chicago office, and insurance regulation is my practice area. So I'm glad to be with you today. Thank you all for joining. Next slide, please. I like to use the term three-legged stool to describe insurance company investment regulation. Three different components that need to be addressed for insurance company investments. The first is that the insurance code in the state of domicile of the insurance company has a group of sections that describe the types of investments that an insurance company is authorized to make. So generally that's a kind of a category pigeonhole approach. In order to make the investment, it has to fit into one of the authorized categories. And then there's a little basket at the end for investments in a limited amount that aren't in one of the other categories. So that's leg one of the three-legged stool. The second one is that the National Association of Insurance Commissioners, which is a service organization and standard setting organization created by the insurance commissioners in the 50 states and District of Columbia and the US territories. The NAIC has developed a system that they call statutory accounting and statutory reporting of investments that is used across all the states. States have the opportunity to modify statutory accounting for the companies domiciled in their states. And there are some states that, principally New York, that will sometimes tend to do that. But generally speaking, the statutory accounting and reporting is uniform across the states. Statutory accounting is more conservative than GAAP, and it focuses on availability of assets to be used to meet obligations to policyholders. So that's the second leg, is the NAIC's statutory accounting and reporting system. And the third leg is that the NAIC has also developed a risk-based capital system that is used across the state to measure whether an insurance company is maintaining a sufficient ratio of capital to its business risks. And there are different types of risks that go into that formula, one of which is investment asset risk. Each asset class has an RBC factor associated with it that's multiplied by the carrying value of the asset to calculate the RBC, the risk-based capital that the insurance company has to hold against that asset. Next slide, please. So the authority of insurance companies to invest in mortgage loans. Although the laws that govern authorized investments, that first leg of the three-legged stool that I mentioned, differ widely across the states, and in some states there are two separate sets of rules, one for life insurance companies and one for non-life, or life and health and P&C. But the NAIC tried to develop some uniformity by creating a model act that they urged states to adopt, so there would be more uniformity across the states. But only 9 states have adopted it, which means that all the rest have their own unique statutes about permitted mortgage loans. But the good news is all of those states, regardless of whether they use the Model Act or their own independent version, do permit insurance companies to invest in mortgage loans. And then, however, the wrinkle is that these statutes differ on some of the details. For example, different states set a cap on what percentage of the insurance company's assets may be invested in mortgage loans. Some actually would, well, many states will have a limit on how much exposure an insurance company can take on to a single obligor, sort of a single obligor limit. Those are unlikely to be triggered by residential mortgage loan investments, but they're part of the statutes. What loan to value ratios are required, and that differs among the states. Whether junior liens are permitted. In some states they are, in some states they're not. In some states they're permitted only if the insurance company also holds the senior lien. So that's a state-by-state variation. And then the states differ in how much they expressly address the fact that mortgage loans may be held through indirect types of vehicles. For example, because of the licensing reason, it's common for insurance companies to use a titling trust to hold residential mortgages where the trustee is a national bank. And that fits in with Holly's topic about exemptions from state licensing requirements that national banks enjoy. But does the statute, when it talks about an insurance company may invest in mortgage loans, does that state statute contemplate that it may be a trust, beneficial interest in a trust that the insurance company holds, as opposed to being the lender of record for the mortgage loan? Now, that's going to differ between among the states, and even if the state statutes don't acknowledge it, it may be that the regulators at the insurance department in the state will acknowledge the ability to hold mortgage loans through indirect mechanisms. The Model Act that the 9 states have says you can own mortgage loans directly or indirectly through trusts, limited liability companies, partnerships, joint ventures, or other business entities. So they have that acknowledged, but not every state does. And that can sometimes be a bit of a wrinkle. Next slide, please. So now that was the first leg. I was talking about the statutes that authorize the different classes of investments, and that is state by state based on the state of domicile of the insurance company. Now we're shifting to the second leg of the three-legged stool, the statutory accounting system. And there's a statement of statutory accounting principles, number 37, that provides the statutory accounting guidance on mortgage loans. And this is what it says. It says a mortgage loan is defined as a debt obligation that is not a security, which is secured by a mortgage on real estate. And then there's a second sentence that expands it a little. It says, in addition to mortgage loans directly originated A mortgage loan also includes mortgage loans acquired or obtained through assignment, syndication, or participation. And participation is an important one because insurance companies will often be participants in a mortgage loan as opposed to the lender of record. Then there are some additional footnotes in that guidance that differentiate what variations might be included or not included in the scope of mortgage loan for statutory accounting purposes. So a bulk purchase is included where the insurance company has a legally separate and divisible interest in each individual mortgage loan, but their mortgage loans are purchased in bulk, each one with its own mortgage loan agreement. And many insurance companies will take the position that a titling trust that has been described before is an example of a bulk purchase. And this is a good place to point out, by the way, that statutory accounting, there's the guidance that's published by the NAIC. But ultimately, how the decisions are made in accounting for investments for statutory accounting purposes is going to be up to the insurance company's statutory accountants, internal accountants, their external accountants who review the decisions, but really ultimately the state regulators, the financial examiners in the state of domicile. They have the final word. And if you would talk to someone at the NAIC and their statutory accounting group and ask a question, their answer will always be prefaced by saying this is all subject to the state insurance department regulators. So that needs to be borne in mind, and state insurance regulators of different states may not always come out the same way. No surprise. What's not included, and in fact is excluded in the Statement of Statutory Accounting Principles, SAP as we call it, number 37, is when an insurance company acquires an interest, a single interest in a bundle of mortgage loans with various unrelated borrowers and collateral. Classic example of that, a commingled fund. What does the insurance company hold? It holds a limited partnership interest in a limited partnership. It holds a membership interest in an LLC, or it holds something that represents an interest in a bundle rather than having an interest in each mortgage loan. And so for statutory accounting purposes, for mortgage loan treatment, this is an important distinction. Next slide, please. Now, individual mortgage, I mentioned we wouldn't say more about participations, and we're there now. Individual mortgage loan participations can qualify for treatment as individual mortgage loans. Remember that definition said, in addition to mortgage loans directly originated, mortgage loans also include mortgage loans that are acquired through assignment, syndication, or participation. So, but there is a very long footnote in SAP 37 that describes what's needed for that participation to qualify as a mortgage loan. And I'll just go quickly through these points. There has to be a signed participation agreement between the insurance company and the lender of record. The financial rights and obligations of the insurer must be the same as the lender of record. The participation in the proceeds must be pari passu with the lender of record. And the participation agreement has to be recorded with the lender of record in its books and records. So next slide, please. So now, how are mortgage loan investments treated for statutory reporting and RBC purposes? Now we're going from a little bit on the second leg of statutory reporting and the third leg of the stool, the RBC. So if the mortgage loans or participations meet that SAP 37 definition that we talked about, then they are reported as individual line items on Schedule B, as in Bravo, of the insurance company's statutory investment schedules, loan by loan, line by line. So it's possible for insurance companies to have literally hundreds of pages of Schedule B with an individual mortgage on each line. The risk-based capital factors are determined in part by whether the mortgage is residential or commercial. That's not a clear-cut distinction 100% of the time, but we'll assume for our purposes that you know which it is. So the next two slides are going to show how the pre-tax RBC factors for life insurers are assigned for mortgage loans that meet the statutory accounting definition and are reported line by line on Schedule B. And it's going to break down on residential versus commercial and whether they're insured or guaranteed. Next slide, please. So for residential and insured or guaranteed commercial mortgage loans, you see that you have these very low, I probably don't have to tell you that something like 14 basis points or 27 basis points are low RBC factors. They're quite low if it's insured or guaranteed. If it's not insured or guaranteed, then the right-hand column only applies to residential. Commercial will be on a different scale. But for residential mortgages in good standing, the number to focus on is that 68 basis point number. So generally speaking, a Schedule B mortgage loan, residential mortgage loan in good standing will get a 68 basis point RBC charge, which is still rather desirable. And just to give you an idea, 68 basis points is roughly what an A+ bond or debt instrument would get for that different asset class, but it kind of locates you on the spectrum. Next slide, please. Commercial mortgage loans are assigned what's called a CM category, and you see the RBC factors associated with each. The CM category is determined based on the type, or I should really say the use of the commercial property. Are you talking about office? Are you talking about hotel? Are you talking about retail? Each one of those has this maps onto a set of categories. And then where you fall, what category you get assigned to is based on a formulaic parsing of the loan to value ratio and the debt service coverage. So really 3 factors determine the CM category: use of the commercial property, DSC, LTV. And I would say most commonly, CM2 is what's being aimed for, and that's 1.75% RBC factor. And to give an idea of where that maps out on the scale of if it were a bond, that's still going to be equivalent to an investment grade bond, but not like an A+. Next slide, please. So Schedule BA, that's a term you may have heard, Schedule BA mortgage. When an insurance company holds an interest in a joint venture or partnership or limited liability company that owns the mortgage loans, rather than being the lender of record or having the participation agreement that we've been talking about, then those go into a category called other long-term assets on Schedule BA, and they're valued based on the audited GAAP equity of the interest in the JV, the partnership, or LLC. So if the entity that owns the mortgage loans is unaffiliated with the insurance company, say an insurance company invests in a limited partnership that is not run by one of their affiliates and they're just a passive investor, then they actually use the commercial mortgage factors to determine the Schedule BA RBC factor. So this, don't want to get too bogged down in the detail, but here I want to zero in on investments where the underlying mortgages are primarily senior debt. Then that interest in the Schedule BA mortgage investment is going to get a CM2 RBC of 1.75%. If the underlying mortgages are mezzanine or subordinated debt, non-senior, then it's going to get a CM3 category, which would be 3% RBC. Next slide, please. There is a new development in 2024 that is one of the things I wanted to be sure to talk about. They added a new line item. The NAIC added a new line item to the RBC calculation for Schedule BA mortgage loans. Remember, Schedule BA is when it's held indirectly, the mortgages are held indirectly through a JV partnership or LLC. If that JV partnership or LLC is affiliated with the insurance company, then starting with the 2024 calculation, the one that insurance companies are running now for their March 1st RBC report, based on 12/31/24 numbers. If it's affiliated, then the Schedule BA RBC factor for residential mortgage loans in good standing is 68 basis points, same as for a Schedule B mortgage loan. So I told you to kind of focus on that 68 basis point, which has caused many insurance companies to be willing to take the burden of individual line item accounting and holding the mortgage loans individually or through participations to get that 68% low RBC factor. It can now be done through an entity on a Schedule BA mortgage if the loans are in good standing and the entity is an affiliate of the insurance company. So who is an affiliate? The standard definition of affiliate, the same as is used in other statutory accounting and insurance holding company laws. An affiliate is an entity that is controlled by or under common control with the insurance company. And that leads to the next question. Generally, in the world of insurance regulation and statutory accounting, there is a presumption of control, that control exists if one person owns 10% or more of the voting securities of another. So 10% or more of the voting securities would say we're affiliated. And in this case, you want to get to affiliate status if you can to get that 68 basis point RBC in the affiliated Schedule BA line item. Generally, however, a 10% passive investment in a limited partnership would not trigger that presumption of affiliation because the limited partner is controlled by its general partner. And there's actually there is a discussion in SAP 25, which is affiliates and related parties, that actually points that out. That says there's a 10% presumption, but in limited partnerships, it may not apply because the control is with the general partner. However, if the general partner was an affiliate of the insurance company, then you actually have the basis for saying this is one of the affiliated structures that goes on this line item. And I should also point out that to qualify, the mortgage loans do need to be in good standing. So there needs to be a mechanism to transfer any delinquent loans out of the structure, which, remember, in the NAIC system is 90 days or more overdue. Next slide, please. Schedule D, that's another schedule for where mortgage loan investments could appear if they are securities that are backed by mortgage loans. So a securitization like RMBS and CMBS, that's going to be treated as a bond and reported on Schedule D, which is the bond schedule. RBC will be determined by the NAIC risk designation that is assigned by a financial modeling process for MBS. Although for the senior loans in an MBS structure, the NAIC designation does get derived from the rating agency rating. Schedule D assets are carried at amortized cost as long as they're not in default, they're above NAIC 6. If they're NAIC 6, then they're carried at the lower of cost or fair value. And then very importantly, as a new development, there's a new principles-based bond definition as of January 1st of this year. So MBS structures now need to provide substantive credit enhancement in order to qualify as bonds. So there need to be some guarantees or tranching with payment priority or over collateralization so that the holder of the mortgage-backed security is in a better position than if they held the underlying mortgages directly. So a pure pass-through with no unitranche with no tranching or other form of substantive credit enhancement won't qualify as a bond now under the new bond definition. Next slide. Here are the RBC factors for bonds. We don't need to spend time on that, but the slides will be available. So it gives you an idea of the NAIC designation in the left, and then what the equivalent rating agency ratings are and the life RBC factor. Next slide, please. So to sum up, comparison of the different statutory reporting treatments. Schedule B, RESI, the RBC factor comes from the payment status. Is it in good standing, 90 days or more overdue or in process of foreclosure, or whether it's insured or guaranteed. There's no mark to market. It's amortized cost on Schedule B. Schedule B commercial are going to have an RBC factor determined based on the property use, the DSC and LTV. Again, Schedule B is not mark to market. Schedule BA will generally use commercial mortgage categories unless they get the benefit of that affiliated structure with the 68 bips. They are marked, Schedule BA are effectively marked to market because the Schedule BA investment is carried at the audited GAAP equity. And Schedule D gets a credit quality designation based on modeling by the NAIC, and they are carried at amortized cost as long as they're above NAIC 6. Next slide, please. Investment subsidiaries is another subtopic here. Many state insurance codes have the concept of an investment subsidiary, where an insurance company forms a subsidiary with the sole purpose of owning and managing investments the insurance company could have directly owned and managed. And investments made through an investment subsidiary are aggregated with an insurer's direct investments for purposes of quantitative limitations. So if a state said you can't invest more than 25% of your assets in mortgage loans, and the insurance company has 10% of its assets in mortgage loans directly, and then has an investment subsidiary that makes investments in mortgage loans, those investments through the subsidiary would have to be aggregated with the 10% held directly to be tested against the 25% limit. That makes logical sense. RBC for investment subsidiaries is calculated on a look-through basis. You look at the mortgages held through the investment subsidiary and use whatever RBC they would have had assigned to them. Different practice on how insurance companies account for and report their mortgage loan investments made through investment subsidiaries. I've seen some companies use Schedule D, where the subsidiary is actually an entity on one of the parts of Schedule D, I think Section 1, Part 6, or Part 6, Part 1, Section 6, for investment subsidiaries at the GAAP equity. Sometimes there's a Schedule B reporting based on a look-through to the underlying individual mortgage loans. It's really going to depend, back to my earlier point, on what the state insurance department and the insurance company state of domicile is comfortable with how the investment subsidiary is treated. There's not uniformity on this. In fact, the NAIC Statutory Accounting Principles Working Group has an agenda item that they exposed with a comment deadline of this Friday on whether there needs to be more guidance to create more uniformity on investment subsidiaries. Next slide, please. That brings me to the end of my part, and hopefully I haven't put everybody to sleep, but I want to turn it over to my colleague, Tamim Zainalbai, for a discussion of some of the structures.
Thanks a lot, Larry. Next slide, please. My name is Tamim Zainalbai, and I'm a partner in the finance group here in Chicago. And myself, along with my colleague Hawker, who's going to speak next, really work to kind of take what Larry and Holly have spoken about and kind of operationalize it and create the structures that actually that the insurance companies and others actually use to acquire residential mortgage loans. And so Hawker and I are going to talk about a couple of different structures. I'm going to talk about one that we see kind of used today, and Hawker's going to talk about one that can that can be used for based on changes to Schedule BA. And as Larry mentioned, kind of the holy grail for residential mortgage loans is to be able to get the 68 basis point RBC factor. And this is one way that we've seen insurance companies do that. And so on the screen that you see right now is an example of how some of these have been set up. And the purpose of this particular structure is to allow assets to be reported on Schedule B, residential mortgage loans on Schedule B, and without raising any of the licensing concerns that apply to residential mortgage loans, in particular, since residential mortgage loans compared to other assets have particular licensing issues. So typically what we do here in the boxes in orange are to set up a Delaware statutory trust. It can be any trust, but almost always we set it up as a Delaware statutory trust. And the trustee of that trust is a federally regulated institutions. So that tends to be either a national bank or a federal savings bank. Each trust, as you can see, are wholly owned by the insurance companies. And the trust then enters into agreements, those are the red boxes, with third parties such as for servicers, document custodians, et cetera. Then the trust goes and acquires loans from third parties. And at the top, what you see is the asset manager, and typically the asset manager enters into an investment management agreement directly with the insurance companies, and they also act as the administrator of the trust. And so the way that we set these up is that the asset manager kind of handles the day-to-day business of the trust on behalf of the trust and on behalf of the insurance company. Oftentimes, we set up these trusts in series, which just means that we can have multiple series within the same trust, and that allows for kind of the maximum amount of flexibility to accommodate various insurance company needs, depending on how and what they're doing with these residential mortgage loans, like pledging to the FHLB is a very big one, or entering into different types of reinsurance arrangements. And so the key here from kind of the licensing concern perspective is that legal title to all the mortgage loans, the way that we set it up is legal title is always in the name of the national bank, federally regulated trustee on behalf of the trust. And so each mortgage loan is owned by the trust beneficially, legal title to which is held by the trustee on behalf of the trust. And what that does is there are many state licensing regimes that specifically exclude any federally regulated institutions. And there's also an argument to be made for federal preemption. And that's kind of how we accommodate the licensing aspect of it. As Larry mentioned earlier in the presentation, for Schedule B, as in boy, reporting, we have these loans kind of meet the SAP 37 definition of mortgage loans, and we have it so that the owner of the trust, the insurance company, has kind of the ultimate interest in each of the mortgage loans via the trust. And so in order to facilitate that Schedule B treatment, we also think it's good practice to have the trust agreement or language in the trust agreement that is kind of participation-like to address the participation language that Larry mentioned in SAP 37. So that's kind of how we see trust set up today. And ultimately, as Larry said, the determination as to whether this meets the requirements to be able to report RMLs on a line-by-line basis on Schedule B is up to the internal and external accountants of the insurance company, and ultimately to the relevant state insurance regulators. And so it's kind of a varying scale as to what each of those parties looks at and gets comfortable with. But this is how we've set up structures for many different insurance companies. And now I kind of pass it on to Hocker to talk about other structures that we've thought about and have considered given changes to statutory accounting rules.
Yeah, thank you, Tamim. It appears that the host has locked out my video, so I'm unable to turn on the camera. I don't know, Jesse, if it's something that you can fix on your end. But next slide, please. Wanted to kind of, I think that the new line item in Schedule BA that Larry covered adds a lot of flexibility as to how asset managers that are managing mortgage loan investments for multiple insurance companies can structure those investments. And here's one such option, which is a kind of a commingled fund. I think in the past, in order to achieve the Schedule B 68 basis point treatment for kind of non-guaranteed loans, generally we've thought that you'd had to hold those loans on a siloed basis. So each insurance company would have a segregated pool, and you kind of saw in the picture that Tamim just went over that there were kind of two sets of arrangements with, you know, each third-party sellers. If you had two insurance companies or 5 or 10, you would generally have, you know, 2, 5 or 10 sets of agreements with all these parties. So in this structure, there is a series trust vehicle that's kind of shared by the insurance companies. I think if we go by Larry's rule of 10% voting control, you could have presumably up to 9 or 10 insurance companies investing in these kind of commingled vehicles, each of them owning at least 10% of the voting shares. And so we start at the top here. We've the fund LLCs here. We've kind of set this up with 2 fund LLC, and the purpose of the 2 is, as Larry noted, our understanding from the NAIC accountants is that in order to qualify for the affiliate mortgage loan in good standing 68 basis point Schedule BA treatment, each of the loans in the commingled vehicle needs to be in good standing. And so we've set up 2 vehicles, one to hold the loans that are in good standing and the other one to hold the loans that are not in good standing. And the idea is that if a loan goes delinquent or drops out of the good standing characterization, we would move it from the good standing fund that has the 68 basis points risk-based capital treatment to the kind of the other designation, which, you know, will have a higher risk-based capital treatment, and presumably or hopefully that population in the other bucket will remain relatively low. And in order to do that, we would propose that the most efficient way would be to have the fund LLCs here each own a series in a series trust. And in this sample, I think it's a Delaware statutory trust. It could easily be a New York common law trust as well. But the idea is that under the Delaware Statutory Trust Act, the legal title to the mortgage loans would be held in the name of the nationally chartered trustee, as we've been talking about, and we'll kind of put a pin on how the Maryland development kind of shakes out. But the trustee would hold the loans in its capacity as trustee, and then on the books and records of the trust, you are able under the Delaware Statutory Trust Act to allocate the assets of the trust to a particular series. So here we would provide in the trust agreement that mortgage loans that are in good standing are allocated to the good standing series, and all other loans are allocated to the other series. And the economy here is, as you can see, is all the loans that are acquired go into the same trust. So you only need one set of MLPAs, one set of servicing agreement, one set of one trust agreement, and one set of custodial agreements. And so this is one example. You could see also, opportunities here for JV arrangement where you might have a mortgage loan originator that you want to have retain skin in the game, if you will, and you could structure this in a way where in place of another insurance company, you would have the originator owning a economic interest in the vehicle in order to kind of properly align incentive if that is desired outcome. I guess the downside of this structure kind of off the bat is, unlike the structure that Tamim went over, which I guess is a sample of kind of the prevailing arrangement. It's hard to see how an insurance company could get Federal Home Loan Bank financing on mortgage loans that are held in on a commingled basis like this, because well, at the very least, as a pledge of the mortgage loans themselves, because generally speaking, the home loan banks are going to be looking for a lien on the entirety of the loan, and a kind of a pro rata portion that's represented through the ownership interest in the structures is probably not going to be appealing as things stand right now. And so that's I think kind of the update. Again, I think that there's going to be a lot of opportunity for invention in this space when we have the ability with these new Schedule BA line item changes to provide for 68 basis point risk-based capital conclusion on mortgage loan pools that are not kind of wholly owned by the related insurance companies. And so with that, I think we have probably clear some time for questions here at the end. I think you're on mute still.
Hi, there we go. Sorry about that. I agree. Yeah, I think we've had a bunch of questions come in, so we'll do our best to kind of manage, get through them and answer as many as we can as we're doing this live. One question that came in, I think Larry, maybe you could address, it relates to what Hawker was just talking about, this affiliated fund structure and the need to move the funds out of the from one fund into the other. The question is, why do you need to move the delinquent loans to a different fund? Does the presence of one delinquent loan taint the RBC charge of 68 basis points of all mortgage loans in the fund?
That's a great question, and it's formulated well. Another way to put it would be, does one bad apple spoil the whole barrel? And I've talked with some of the statutory accounting staff at the NAIC about this, and but so far, and this could change. And again, it's subject to, I sound like a broken record, but I've got to say it, I'm a lawyer, not a statutory accountant. I can't give statutory accounting advice. But it's all ultimately up to the insurance company's own statutory accountants, internal, and most of all, the state insurance department. So if an insurance company is domiciled in a particular state that has a different view, that view is going to prevail. But my initial conversations with the statutory accounting staff at the NAIC were, yes, residential mortgage loans in good standing means residential mortgage loans in good standing. How can you get that RBC factor if the loans are not all residential mortgage loans in good standing? So I'm just reporting based on the conversations I've had. I understand the logic of your question. So far, this is the guidance I've received.
Right, and I think, like Hawker said, I think there's going to be a lot of room for innovation, and I think in this market. So we'll see how some of this stuff develops as more sponsors and investors start actually utilizing the structure and taking advantage of the new affiliate fund rules. Let's see, I guess, Holly, do you want to take some questions? I know we've had some on the Maryland licensing. And I think I can't hear Holly. I'm not sure if anyone else can.
Everyone hear me okay?
Now we can, yeah.
Okay, great. Rather than read the question, I'll just summarize. A question came in as it relates to the Maryland guidance, and specifically whether or not the case at issue or the case that was sort of precedent to the Maryland guidance would be on appeal. I think that case, that was an appellate decision in April 2024. Notwithstanding that case, the Office of Financial Regulation has adopted essentially the same viewpoint. I think there is discussion about whether there will be a legislative fix. the April 10th deadline appears to be connected with the Maryland House and legislature schedule. So I think there is some discussion about whether or not the legislature might step in and create a fix as it relates to the application of assignees, the licensing requirement to assignees, and specifically to national bank trustees. So there's definitely more to come on that. There's lots of questions about whether the guidance even extends beyond residential mortgage loan assets. Could it also extend to consumer loans that are made subject to the credit grantor provisions in the Maryland statute? And I think the answer is yes, it could. But again, there's a lot still, I think, to unfold on this particular issue, whether or not the legislature will take it up, whether or not there's revised guidance. But lots to look out for as it relates to the Maryland issue.
Okay, we had one question come in: with the new structure for a commingled fund for residential mortgage loans work as a fund of one, with the investor being an affiliate of the insurance company? And I think, Larry, the answer to that is going to be yes, right? And
Well, do you mean with the general partner or the manager of the fund being an affiliate of the insurance company?
yes,
The
yes,
fund of one, the insurance company is investing in the fund of one, but the GP or the manager would be an affiliate. That should work. Again, caveat, I'm not a statutory accountant, but that seems to check the boxes. It's Schedule BA asset, which is SAP 48, by the way, and affiliate because the control is held by this general partner or manager for an LLC and is affiliated.
and I guess even if it wasn't affiliated, if you structured the fund of the investor's interest in that fund of one so that the interest was voting securities and we could otherwise meet the requirements, it doesn't have to be commingled necessarily, right? As long as they could hold 100% of the interests in that fund of one and qualify for the affiliated fund exception, as long as the other conditions were met.
There are a lot of questions coming in, I can see.
Right, that's right.
One interesting question that somebody had mentioned says, isn't it true that to qualify as an admitted asset, the debt issued in the securitization must be supported by collateral that's also an admitted asset if held directly? That's a really great question. And the answer is, if the securitization results in a debt security that meets the bond definition, the principles-based bond definition, which for asset-backed security means you have to have substantive credit enhancement and either underlying assets that are financial assets, or if they're not financial assets, they generate what's called meaningful cash flows. And if it's underlying equity, you have to rebut the presumption that underlying equity means it's not a bond by showing that the equity risks have been redistributed through the structure. There's your substantive credit enhancement, and that the underlying will produce bond-like cash flows. But if you satisfy that principles-based bond definition, the underlying collateral can be anything, doesn't have to be admitted assets. If you fail the bond definition and you hold a debt security that doesn't meet those tests, then it's called a non-bond debt security. It goes on Schedule BA, new section of Schedule BA. And then if the underlying are not admitted assets, it is the non-bond debt security is not an admitted asset. So you can have anything you want as the collateral if you meet the new principles-based bond definition tests. If you fail that test, then non-admitted collateral means a non-admitted asset for the debt security, the securitization.
Is everyone else is looking through the questions to see if there's any more we can answer here? I'll just repeat the CLE code for everyone listening. Again, it's mortgage, all caps, 28. So mortgage 28. Anything else? I know, were you going to answer the financing question, Hucker? Is financing permitted structures?
Yeah, I think that the question was, can you in the new structure that I kind of went through, is leverage possible? And I think the answer is yes. I think it's possible if it's a fund of one, like we talked about, that the Federal Home Loan Bank would lend against the loans with an affiliate pledge, but non-Federal Home Loan Bank financing should be available at either the fund level or the trust level.
The one thing I would add is that you do want to make sure that your accountants that the insurance company's accountants are comfortable that they still qualify as a senior financing, which is just, I think there's still some uncertainty about that, but that's for the statutory accountants to answer.
There's a question about how does client interaction typically work if an SMA is used? And I think typically what we see is the asset manager kind of comes to the insurance company, but we see it both ways. But one example is the asset manager comes to the insurance company and kind of provides an idea of what services they can provide. And then, Mayor Brown either represents one or the other parties, kind of helping to coordinate the creation of the trust, and the asset manager kind of has a preference as to what third parties and where they're sourcing loans and things like that. So oftentimes the asset manager does a lot of the work, especially on a day-to-day basis and on the creation basis. But there's also scenarios where the insurance company kind of wants to be in the driver's seat and have views on how they want to structure the vehicle and who they want to be involved with. So we see it kind of both ways.
Yeah, some variation usually of an agreed upon buy box that the insurance company has vetted that makes sure that it's going to meet their, as Larry talked about, statutory accounting and other requirements, and then a spectrum of involvement and consent rights over sort of day-to-day activities and investment activity that gets negotiated between the parties depending on preferences and specifics.
Larry, there's a question about what is an insured or guaranteed loan for RBC purposes.
Yeah, for RBC purposes, that's going to mean federally insured or guaranteed.
Okay. There's a couple questions here that I think we probably have to think about a little bit more. But one, Larry, that I know we've talked about before is second liens. And do you want to just talk a little bit about how second liens are treated, especially when it comes to kind of state insurance code as well?
Well, I mentioned that a little bit in the first part of my talk. That's going to vary widely across the states. In the section of the insurance code that deals with authorizing investments in mortgage loans, it's going to address that. It's going to say something like may invest in mortgages secured by first liens on real property. And there'll be another section or another sentence that would address whether second liens, if it doesn't say anything about second liens, then by implication, second liens are not authorized except perhaps in the basket, but not under the mortgage investment clause. But sometimes they'll say things like, can it hold the second lien mortgage if the insurer also holds the first lien? Sometimes there will be second liens are permitted, but might have their own LTV requirements associated with second liens. There could be a restriction on the amount that insurance companies can invest in mortgages that aren't first liens. That's all going to be, look up the insurance code for the insurance company's state of domicile and see what it says, because I was recently asked to look at 2 different states for a client, and the answers were completely different, really, based on what each state statute had. So I can't generalize.
There are 2 questions about kind of how you've seen insurance companies hold mortgage loans via Schedule D as in David, and whether you can use an issuer credit obligation. or if not, how have you seen insurance companies report on Schedule D for residential mortgage loans?
Yeah, so for Schedule D would include any securitizations of mortgage loans, right? Because Schedule D is bonds, also common and preferred stock go on Schedule D, but let's start with the bonds. So securitization of mortgage loans would be a Schedule D asset. And the investment subsidiaries, there is a subsection of Schedule D that is used for reporting investment subsidiaries. So that is where they treat the investment subsidiary as a common stock, quote unquote, investment. But I think the question here dealt with issuer credit obligation. Issuer credit obligation is a technical term from the new principles-based bond definition. That's not really on topic, but I'll go into it just enough to answer the question. The new principles-based bond definition applies to all bonds in insurance companies' portfolio now as of January 1st, no grandfathering. Pre-existing investments have to meet the test now too. Principle-based bond definition says that a bond is a security which represents a creditor relationship, which provides for a schedule of one or more future payments, and is either an issuer credit obligation or an asset-backed security. An issuer credit obligation is where the repayment is supported by the general creditworthiness of an operating entity. And an asset-backed security is everything else where the repayment is supported by cash flows from some underlying collateral. So the question here is whether there could be I just want to see the question again. It was referring to a fund that is an ICO, an issuer credit obligation. I'm just looking for the exact wording of it.
It was, can you utilize an issuer credit obligation to hold mortgage loans and be able to file such investment on Schedule D?
Yeah, so to be an issuer credit obligation, the fund would need to be an operating entity rather than a securitization vehicle. It's a securitization vehicle, you're in the world of asset-backed security. But funds, the original definition that was adopted for principles-based bond definition provided that SEC registered funds were operating entities that could issue issuer credit obligations, but unregistered funds couldn't. They had to go into the asset-backed side where you need that substantive credit enhancement and would be more difficult to meet the definition. But an issuer credit obligation now includes all operating funds, not just registered, but they have to qualify as an operating entity, meaning that their primary purpose is to raise equity capital and generate equity returns for investors. And debt, if it's utilized, is ancillary to the primary equity objective of the fund. So you have an operating fund and it gets a credit facility, if you will, to provide some leverage. It's a relatively, they don't give you an amount of what percentage it has to be. They just say it has to be ancillary to a primary equity objective of the fund. So some kinds of debt leverage could be bonds, Schedule D ICOs, if they meet the other components of the definition. But here, when you're talking about a fund, I assume you're talking about holding equity in the fund, right? Being a partner in the fund or a member of an LLC. And that interest would never be a bond because that's equity. The only bond component in the capital structure of an operating fund would be if there is an limited ancillary use of debt to support the equity objective. That debt could be an ICO. But otherwise, when we're talking about funds that hold mortgages, we're talking about the Schedule BA asset, which are joint ventures, partnerships, and limited liability companies with the underlying characteristics of mortgage loans. And that we've talked about those as Schedule BA mortgages. So I may not be understanding the question, but I'm not seeing a path for the equity interest in a fund to ever be an ICO or a bond of any kind because it's equity. But if it's a debt leverage provided to the fund, then that has the potential to be an ICO.
Maybe this is a good segue to, we're putting on another program in 2 weeks on rated note feeders and the use of rated note feeders, which is one way that we kind of convert what is otherwise and it would have been an investment into a fund to get better risk-based capital treatment on that. So we're doing that on February 11th, same time as this, I think 11 Central, 12 Eastern. And I think everyone on this list will get an invite to that, and we encourage you to join us for that as well. We're obviously seeing, they're not really new technology anymore, but certainly they've proliferated and are continue to be attractive to insurance company investors. So I think with that, we'll probably wrap this program up. If anyone else has any additional questions, we always love to hear from everyone. So we encourage you to reach out to any of us or any of our colleagues. And we'd be happy to discuss anything further. And
the slides should be available on the website.
That's right. Yeah. So it might take a day or two to get them up there, but like our prior one, which I do again, a little plug for our prior program, which was sort of, especially if this is new to you, it was a much more comprehensive overview of sort of all of the different aspects that go into insurance company investment into mortgage loans. So check out that, and then our update will also be available shortly. Thank you all for joining us.